Hey guys, welcome to topic 9 of investment analysis, and today's topic is individuals and investment process. This is a chapter 22 of your textbook content. Now let's first look at this figure over here. This is a figure of the portfolio management process, and this process actually typically consists of 3 phases. So the first phase would be the planning phase, the second phase would be the execution phase, and the third phase is feedback. So if we look at the planning phase first, we usually start from a set of information about the investor objectives, constraints, and preferences. And based on those information, the portfolio manager would be able to form portfolio policies and strategies. And that's the planning phase. And then we move on to the execution phase. So during this phase, we would be doing portfolio construction and revision. More specifically, we would be doing asset allocation, portfolio optimization, security selection, etc. So this means we would be having asset allocation policies, portfolio optimization policies, and security selection policies as well. And also this portfolio construction and revision is actually jointly determined by both the portfolio policies and strategies, as well as the capital market expectations. And moreover, during this execution phase, the portfolio managers need to also monitor at the same time of doing the portfolio construction, they have to also monitor the investor related input factors and to monitor economic and market input factors. So basically they have to monitor any possible changes in those factors. So that's the execution phase. Then we move on to the feedback phase. So here, the portfolio manager would be evaluating the performance of the portfolio. So basically, the portfolio manager would be doing performance measurement. For example, the portfolio manager would be calculating the Sharpe ratio of the portfolio, and actually the performance measurement will feed back into the planning and execution phase of this process. What do I mean by that? I think a simple example can help you comprehend this. So the simple example is that the portfolio manager might be adjusting the strategies to gain a higher Sharpe ratio. Now let's look at the information about the investors will be needed to be gathered when we set up an IPS. So IPS is a short name for the investment policy statement. So this IPS serves as a strategic guide to the planning and implementation of an investment program. And we have this practical example here. This is a link to an investor questionnaire. So this is a questionnaire that gathers investor information that will be needed to construct the IPS. So if you guys are interested, feel free to click onto this link to see how those questions look like. Actually, we have more general sample questions here. So the sample questions can be, what are the real risks of an adverse financial outcome? And what are the emotional reactions this investor will have. And the second question can be how knowledgeable is the investor about investments and the financial markets. The third question is what other capital or income sources does this investor have? And how important is this particular portfolio to the investor's overall financial position? And the final question is how would any unanticipated portfolio value change might affect the investor's investment policy? Actually, all those questions are related with the risk tolerance level of the investor. So if we look at the second question, how knowledgeable am I about investments and the financial markets? Effectively, if you have a higher level of knowledge, you actually might feel more comfortable pursuing the more complex or more risky investment strategies. Also, like, for example, if you look at the third question, what other capital or income sources do I have? Technically speaking, the more income sources you have, the higher risk you can bear, right? With respect to this specific investment. So you would be having higher risk tolerance level with regard to this specific investment. Now, let's take a look at IPS itself. The two major components of IPS are objectives and constraints. So, which actually determine the portfolio policies. So for objectives, we have two categories: return objectives and risk tolerance objectives. So those return requirements can be divided into can be actually divided into capital preservation, capital appreciation, and etc. We will discuss this in more details in later slides. And for risk tolerance, we might have risk-averse investors. We might also have risk-tolerant investors. And another component of IPS is the constraint. Is the constraints. So examples of the constraints include liquidity needs, investment horizon, regulation considerations, tax considerations, and unique needs. So we will discuss all those constraints in more details in later slides. Now, let's look at the unique needs. So for unique needs, for individuals, it might those unique needs might be ethical concerns. So for example, this investor is more inclined to invest in environmental friendly portfolios. So this investor might be more inclined to invest in ESG focused portfolios. That's one example of unique needs. And another example of unique needs can be specific hedging needs. So what does this mean? So if you think about aerospace engineers who hold large shares of the companies they work at, and those aerospace engineers will actually perhaps try to buy portfolios that can hedge the risk of a deterioration of the economic well-being of the aerospace industry, of the industry they work in. So that's specific hedging needs. And other unique needs can be associated with the investor's age or the investor's wealth. Now let's look at the risk objectives in more details. So risk objectives, or how much risk the investor can take, is determined by both the ability and the willingness to take risk. And the ability to take risk is associated with the investor's current net worth and as well as the income expectations, while the willingness to take risk is related with the investor's age. More specifically, we know that actually more net worth would allow more risk taking, and younger people can also take more risk. Younger people is more willing to take more risk. So one more thing I want to emphasize here is that we need to always determine risk tolerance first, and our return objectives will be built upon those information on the risk tolerance. So in other words, our return objectives should be matching with the risk objectives. Now on to return objectives. So the return objective can be stated either in terms of an absolute percentage return or a relative percentage return. So absolute percentage return just refers to the actual portfolio return, while the relative return refers to the return relative to a benchmark index return. And we have four common categories of the return objectives. So the first is capital preservation. It is associated with minimizing the losses denoted in real terms. So not the losses denoted in nominal terms, but in real terms. That's capital preservation. As we can see from the name, it's an objective that is less aggressive. And we also have capital appreciation. This is also related with the real values of the portfolio, instead of the nominal values. So capital appreciation focus on maximizing the growth of the portfolio in real terms. That's capital appreciation. And aside from those two categories associated with the real values of portfolio, we also have current income and total return. So the current income focus on generating income. So generating the current income streams, such as dividend streams or interest payment streams, rather than generating capital gains. So capital gains is just a rise in asset value. And we also have total return, right? So the total return objective means that the portfolio manager, actually the individual investor would want to increase the portfolio value by both obtaining high current income and also high capital gains at the same time. Now let's take a look at an example of identifying return objectives. This example include two types of investors. One is a 25-year-old investor, and the other is a 60-year-old investor. So this younger investor has a characteristic of a steady job and also adequate insurance coverage, and also enough money in the bank to provide a cash reserve. And his goal is to build a retirement fund. On the other hand, the older investor actually have quite similar characteristics as the younger one, but the difference is that the older investor is now retiring this year and expected to live an average of another 20 years. With this characteristics of those two investors, we can actually identify the return objectives for them. So basically, because the young investor is having high income growth potential, and also this investor has really young age. As we discussed previously, this young investor should be having a high risk tolerance, and this high risk tolerance can accommodate more aggressive return objectives. So what are those more aggressive return objectives? So actually the more aggressive one can be the total return, and also the capital appreciation. So these two, capital appreciation and total return. So that's what we find suitable for the return objective of this young investor. On the other hand, for this old investor, he can actually either be risk averse or risk tolerant. As we discussed previously, it really depends on his wealth level. So if he has high wealth level, he might be risk tolerant. And if he is actually risk averse, he might be choosing a mix of less aggressive return objectives. So as we discussed, capital preservation is actually less risky. And also, aside from this capital preservation, the risk-averse investor would actually choose a mix of this capital preservation with another strategy. And the other strategy should actually be current income, because imagine that you being this old investor, you will definitely be needing stable income streams, right? So the current income approach will provide this stable income stream. And if you as the old investor, you are risk tolerant, then you will choose a mix of current income and this total return objective. So as we discussed previously, this total return approach is more risky, it's more aggressive. And with this return objective, we can actually also be able to determine the portfolio allocation for those two investors. For this 25-year-old investor, because he has really high risk tolerance levels and also really aggressive return objectives. So we can actually choose to invest in the more risky asset categories. So we can mainly expose the portfolio to foreign and domestic equity. The percentage can be 80% to 95%, and the remaining funds can be invested in short-term and intermediate-term notes and bonds, so the safer assets. And if we are dealing with this old investor, because this old investor always wanted this stable income stream, right? No matter he is risk averse or risk tolerant. So we should expose a major proportion of this portfolio to bonds So bonds should comprise 50% to 65%. And among those investment in bonds, we might invest 5 to 15% in treasury notes. This is for the sake of extra liquidity and safety. And we should be investing the remaining 35% to 45% in high quality stocks. So basically those blue chip stocks with risk similar to S&P 500 or ASX 200 index. Now on to the investment constraints. So far we have discussed about the return objectives as well as the risk objectives. Now let's take a look at investment constraints. So one, as we said earlier, one of the investment constraints can be liquidity needs. So liquidity needs refer to the demand for readily available cash or assets that can be quickly converted into cash without significant loss in value. So these liquidity needs can vary between investors depending on their age, employment, tax status, etc. And so the liquidity, so for example, the liquidity needs can be due to the planned vacation expenses or the house down payment. Another example of investment constraints is time horizon. So time horizon is just the investment horizon actually. The investment horizon refers to the length of time an investor expects to hold an investment before selling it or liquidating it or before the investment matures. It's essentially just the duration between the initial investment and the point in which the investor plans to cash out or exceed the investment. So that's a definition for investment horizon. And as a result, the investment horizon will actually influence liquidity needs and risk tolerance. More specifically, the longer investment horizons generally will require less liquidity and also allow for more risk tolerance. So, which means that a longer time horizon typically allows for more aggressive investments, such as stocks or real assets. And those investments would have historically provided higher returns, but also come with higher volatility. Another example of investment constraints is actually tax concerns. For tax concerns, we know that first. So for tax concerns, let's get a few concepts straight, and then we will proceed to discuss an example of tax concerns. So we have capital gains or losses. And as we have previously discussed, capital gains or losses are just the rises or the decreases in the values of the asset. And those capital gains would be taxed separately from income. So capital gain taxes and income taxes are different taxes. And we actually do not need to pay taxes for unrealized capital gains. What do we mean by unrealized capital gains? This is a price appreciation of currently held asset, and those assets are not sold yet. So that's why we call it unrealized. And what about realized capital gains? This is a capital gains that has already been achieved by selling the asset. So for this type of capital gains, we have to pay the tax. And if we look at this figure here, we will find out that actually tax has a huge impact on portfolio returns, on investment returns. So the before tax and inflation return of ordinary shares is 7.68%. And after, so for this same instrument category, if we check the after-tax return, it's 5.98%. So the difference among those two returns is almost 2%. So this means tax does have a huge impact on investment returns. And also the same is true for other investment categories. Yeah, we have already discussed about those three concepts: capital gains or losses, unrealized capital gains, realized capital gains. So actually, given those concepts, so an example of tax concerns is that there is a trade-off between taxes and diversification. What do I mean by that? Diversification generally involves spreading investment across different assets to reduce risk, right? And holding a concentrated position in a single company's shares would expose the investors to company-specific risk. So we can always try to sell some of these shares and diversify into other assets, such as mutual funds, ETFs, or just different stocks. By doing so, the investors can potentially reduce their overall portfolio risk. But the concern is that the selling of those shares can actually make gains or losses become realized. So those unrealized gains or losses will now become realized and would serve have tax consequences. So on the one hand, we have the benefits of diversification. On the other hand, such diversification efforts will trigger tax consequences. Now onto the final categories of constraints: unique needs and preferences. So we actually have already discussed this first point here. Personal preferences, such as socially conscious investments, could influence the investment choice. So as we said, the investor might be more inclined to invest in environmental friendly portfolios. So they might want to invest in ESG focused portfolios. That's personal preferences, such as the socially conscious investments, and the unique needs for individuals can also include time constraints or lack of expertise. So these 2 points, personal preferences, time constraints, or lack of expertise, are all unique needs of individuals. And also we have this third point here. This is also the constraint, the constraint for the individuals that we have discussed before. So we might have large investment in employers' shares, and this investment can require consideration of diversification needs or hedging needs. So we have to hedge our position in the employer's shares. Yeah, just recall about the aerospace engineer example, right? They have to basically hedge the downside of the aerospace industry. So they have to buy a portfolio that moves opposite to the movements in the aerospace industry. That's the idea of this point. Of course, the unique needs are not limited to individual investors. The unique needs are uh, can also be seen among can also be seen among institutional investors as well. So, for example, if we look at pension funds, those different pension funds will actually differ in their investment policy depending on the average age of plan participants. So that's one example of the unique needs of institutional investors. Now onto the now let's take a look at the example of investment constraints. Again, we are comparing and contrasting a 25-year-old investor with a 60-year-old investor. For this 25-year-old investor, this younger investor, the liquidity needs constraint can be that uh, actually for this 25-year-old investor, the liquidity needs is really low because basically because the retirement is far away, like for this young investor. And this liquidity constraint can change following some events. For example, the unemployment of this 25-year-old investor and also the house down payment, etc. If we consider about the older investor, the liquidity needs can primarily be driven by unexpected expenses or bills. And the younger investor would be having long time horizon, long investment horizon, like given their uh, their expected lifespan, right? So the 25-year-old definitely have a longer expected lifespan. So that's why they would be having a longer time horizon, longer investment horizon. For the 60-year-old investors, the investment horizon is very short. Now onto the constraint called taxes considerations. For this younger investor, the tax bracket is really low, while on the other hand, for the older investor, the tax bracket is very high, perhaps because of their high wealth level. Um, Also, another category of the investment constraints we discussed about is regulations, right? So the example for regulations for this young investor can actually be considerations about insider trading or market manipulation. And otherwise, this young investor actually have little issues with legal and regulatory matters. So in general, he would be obedient, but he might get involved in insider trading or market manipulation. And for this older investor, he probably like same as a 25-year-old. He has little issue with regard to other legal and regulatory matters, but this older investor might have to follow the legal and tax advice when he is doing estate planning, so distribution of his assets after his death, or he might also need to follow the legal and tax advices for setting up of trust accounts. Yeah, that's the example of investment constraints. Now, so far we have discussed about the risk objectives and return objectives, right? IPS actually also contain asset allocation policies and security selection policies, which are determined by those objectives. And among those two types of policies, asset allocation is more important. So let me expand a little bit more about asset allocation first. So asset allocation is a process of deciding how to distribute an investor's wealth among different countries and different asset classes for investment purposes. And for this asset allocation policy, it is mainly the responsibility of investment committee. So what is an investment committee? This is a supervision panel of the company that is comprised of the top management officers, the senior portfolio managers, as well as the senior security analysts. And as I said, the investment committee mainly holds a supervision role and would be responsible for asset allocation policies. And on the other hand, the security selection would be held responsible for by the portfolio managers. So an example of security selection would be just determine which stock and what weight. Also, one more thing about security selection. Actually, most of the overall investment return is not determined by security selection, but determined by asset allocation. So that's why I'm saying that asset allocation is a more important one. Here we have a tree diagram depicting the asset allocation and security selection process. So as we can see on the top, we have the overall portfolio, and we can see that the portfolio distributes 75% into the US markets and 25% into Japan. And among these 75, so out of this 75% invested in the US markets, 15% of the funds is invested into cash, and 40% is invested into fixed income, while 45% is invested into stocks. So for Japan, 60% is invested in fixed income, and the rest is in stocks. Actually, if we look at the tree diagram, anything above and also on this dash line here is about asset allocation policy. So basically, as we discussed, the asset allocation involves the choices of different countries and also the choices of the broad asset classes such as cash, fixed income, and stocks. And on this figure, anything below this dashed line is security selection policy. And one more thing about the tree diagram is that we can actually determine the percentage of each security with regard to the portfolio by looking at this tree diagram. How can we do that? So if we take a look at the US Treasury bonds, we can calculate its percentage by focusing on this trajectory here. So along this trajectory, we know that the overall portfolio invests 75% into US, and in the US markets, the portfolio further invests 40% into fixed income. And out of this fixed 40% invested in the fixed income, 60% is invested into treasury bonds. So the percentage is just calculated as 75%. Sequentially times this 40% and then times 60%. This leads to 18%, which is a percentage of US Treasury bonds. That's the tree diagram of asset allocation and security selection. Now, this final slide here. We know that there is a positive trade-off between risk and return, right? Basically, higher return would be coming with higher risk. That's the reason why investors' risk tolerance, so their ability or willingness to take risk, would affect the asset allocation policy. Simply because the ones who have higher tolerance with regard to risk would always wanna the higher return and higher risk categories, right? So if we take a look at this table here, right, we can see that IBM or the equity category has the highest return as well as the highest volatility. So the highest return of over 10% and the highest volatility of over actually almost 30%. So this slide is just saying that the reason that the investors' risk tolerance can affect asset allocation is because of the positive relationship between return and risk. That's all of the content of today. Thanks for attending this lecture.